Thank you, Michael, and good morning, everyone. If you just bear with me a moment, I will just share our screen. Excellent. Hopefully you can all see that. Joining me today to my left and to your right is Nick Fine, who is AssetVal's infrastructure leader. Nick specialises in the valuation of infrastructure assets such as roads, sewer networks, drainage, curbing, channelling, etc. And for myself, I'm the state valuation manager for AssetVal. My specialisation is the valuation of land and building assets. And then joining us a little later in the presentation is Nathan Turner from JLT, who manages the local government mutual asset valuation programme, which we as AssetVal are also involved in. There are some synergies between what we're going to talk about today, so we just thought it was useful to have Nathan along to talk about that side of the valuation project, the valuation process, and how what we do feeds into the work that Nathan does. So just a quick summary of what we're going to briefly talk about today. We'll just talk about what a valuation is, why they are undertaken, the various different purposes that a party or a reporting entity might procure a valuation. We're going to talk about how we value different asset classes, which is probably more specific to the financial reporting valuation space. We're going to talk a little bit about the valuation methods and inputs into each of those different asset classes. We'll talk a little bit about the types of audit queries that we get and how we answer those and how we can help smooth that audit process, which pretty much comes at the end of the valuation project. We're going to hand over to Nathan to talk a little bit about insurance valuations, and we'll talk about the differences between an insurance valuation and a financial reporting valuation. And then we've got a little bit of time at the end for some questions and answers. So we'll fire up the live Q&A box very shortly. So just diving straight in, what is a valuation? This is a sort of a broad spectrum definition. It's an established ethical and evidence-based process for assessing the monetary value of an asset at a specified date that is legally defensible and undertaken by a qualified professional valuer. And the last few words of that sentence are very, very pertinent. In your own lives, you may approach someone like a real estate agent and ask them for a valuation of your house. There is a little bit of a difference in what you're getting in that is an actually an appraisal rather than a valuation. There's a little bit of a difference there. So whilst a valuation is a sort of, in layman's terms, a statement of worth, we tend to use the phrase market value, and there's a definition of market value there on the screen for you. And moving through that process a little bit further into the financial reporting space, we also use the definition of fair value, which again, the definition is on the screen there: the price that will be received to sell an asset or paid to transfer a liability in an orderly transaction between market participants at the measurement date. A little bit of a difference between the two, market value and fair value, is that reference to market participants. The latter definition of fair value sort of allows us to assume that there will be someone in the market for the asset that we are valuing. Under the market valuation approach, there won't necessarily be a prospective purchaser, which can drive the valuation right down. whereas under the fair valuation definition, we assume that there is someone in the market to acquire that asset. So why do we undertake valuations? The primary reasons are on the screen there. For sale or purchase purposes, in your own lives, if you're acquiring a house or any other type of property, you may need to go to a bank, and the bank will instruct a valuer to prepare a valuation it's actually for the bank. It's not for yourself. The valuer's responsibility under that scenario is to the bank and not you as an individual. Again, loan security purposes, if you were to remortgage your house or a property, a valuer would come out and undertake a valuation for you on that property as security. But just diving into the sort of public sector space, the bottom two are the types of valuations that you would more than likely come across, which is the financial reporting valuations and also determining insurable values of your property assets. So I'll just hand over to Nick, who's going to talk to you a little bit about the standards that drive what we do in this space.
Thanks, Nick, and welcome all. As Nick said, there's a few standards under the AASB that we have to abide by with our valuations, and also councils and local governments throughout Queensland will be pretty aware of. There's obviously others than what we've listed on the screen there, but they're the two main ones that affect valuations. While there are others, we just didn't want to list them all out there. A lot of local governments in Queensland, they'll generally be familiar with undertaking comprehensive revaluations every sort of 3 to 5 years, and then potentially doing indexations or materiality justifications in the interim years. So that's one thing that we definitely recommend undertaking in the current economic conditions, is doing indexations between your comprehensive valuations, because we're finding gone are the days are 1 or 2% a year type increases in costs. We're starting to see some, pretty substantial tailwinds in prices in a lot of assets. So yeah, it's sort of really important that in the interim years between the comprehensive valuations that everyone's looking at their asset classes and what sort of materiality is eventuating in those given years. So. So here's just a bit of a summary of the different asset categories that would commonly be found in local government assets. So you've got your land and buildings and other structures, and then you've got your different infrastructure categories. So regardless of the asset category, the same standards and same processes is undertaken to undertake evaluation. There's just some different inputs and different things that you have to look for when doing different asset categories, which we'll get to a little bit later. One thing I've had a few chats with a few local governments is about how the cycles should be sort of structured in a given year, and there's no real right or wrong way to do it. However, we've found in our experience that it can, particularly with extremely small councils that might be in, say, far north Queensland or far western Queensland or central western Queensland, sometimes grouping the revaluations into a given year, doing all asset categories can sometimes make the process a little bit more efficient. Obviously, that's not, for the larger councils in sort of southeast Queensland and central Queensland, that's not, it's not something that can be done. But for the smaller ones, it's something we've found could certainly mitigate some costs for local governments due to, it might take us a day or so to get out to site and a day or so to get back, and there's some large travel costs involved there. So yeah, just thinking about how asset categories can be grouped together in a way that makes sense is something that should be on everyone's minds. Asset categories such as land, buildings, other structures obviously make sense to be undertaken together, because often those assets are all co-located. Obviously, if you've got a building, it has to be located on land, and often other structures are there to support the building assets. So we find those asset categories work quite well when they're valued together, and it's one of those ones where a lot of local governments do those together. And the same applies for sort of water, sewerage, roads, drainage, and all those other asset categories. You know, grouping them together can sometimes make sense as well. So.
It's also relevant that the typical valuer's experience tends to be categorised in similar categories as well.
Yeah.
The infrastructure we tend to have civil engineers on staff that sort of can value those groups of assets, whereas the likes of myself and the valuation firms, we tend to specialise in land and buildings as registered valuers.
Yeah, and that's right. And just from a local government's point of view, like undertaking that comprehensive once every sort of 3 or 4 years can sometimes be a little bit more efficient than undertaking, you know, one asset class every year, particularly for the smaller local governments that are not as well resourced, or they've got smaller teams involved. It can sometimes be a bit more of an efficient way to do it. But yeah, you know, there's no right or wrong way to do it. It's just in our experience, we've sort of found that can work best. So, okay. So here we start to get into the nitty gritty on the different approaches to valuation. So these are the 3 main approaches. You've got the income, market, and cost approach. Income approach is not used as commonly in local government assets, because generally the assets will, to value using this method, you need to have an income stream for the asset. So a good example for that is like a commercial office building that might have, you know, a number of tenants in there, where you can capitalise that income and determine a value based on that. The market and cost approach are probably the approaches that are more commonly used for financial reporting valuations for local governments. So I might let you speak a little bit about the market approach, Nick.
Yeah. So as Nick alluded to, we rarely come across the income approach in public sector asset valuations, though it's not. We do the odd few where if a council owns some property that they lease out on a commercial basis, we will value that property based on the income that it produces, and capitalise that income at an appropriate yield. We mainly use the market and cost approaches, as Nick has alluded to. The market approach tends to be used where evidence is available to support a market approach. Under the AASB 13 hierarchy, which we'll talk a little bit about later, we are guided to use the market approach where applicable, or where evidence is available to support it, but if not, use a cost approach. So market approach typically is used for land assets, where we can investigate comparable sales that have occurred in and around the subject property. If it's a direct comparison, that's great. We just adopt the analysis like for like, but more often than not, we need to make some adjustments to comparable evidence to support the valuation of the subject land that we're investigating. More often than not, we're making adjustments in valuations in the public sector space, because the land assets that are held by the majority of councils have zoning differences from the sales that are available. Typically in the private sector space, and in, you know, we'll see plenty of sales of houses, industrial units, shops, but we don't get to see many parks transacted, or open space transactions, or community assets transactions. So to value those assets, we have to go through a series of adjustments to provide a fair value. If there is no market evidence available, we'll use the cost approach to value building assets. We don't use the cost approach for land, of course. Cost approach is used sort of in the absence of any sales evidence. So we'll typically use the cost approach for buildings such as park infrastructure, community centres, sports facilities, any sort of type of building that councils use to provide their functions and services, except for anything that we can value using the market basis. Cost is also used by Nick to value infrastructure assets, which I'll let him talk about a little bit now.
Yeah, for sure. So yeah, as Nick alluded to, most local government assets are valued using the cost approach because they're sort of public assets that are used for sort of community purposes or to operate council services. So they're very rarely traded or anything like that. So as you sort of go down. Next one. Yeah. Yep.
Sorry, inputs. Yep.
Sorry. Yeah. So here we're down to the AssetVal inputs. As you sort of go down the hierarchy, you sort of start with level 1 inputs, level 2, and level 3. So level 1 very rarely used in local government assets. You're always sort of dealing with level 2 and level 3, and if you're using the cost approach, you're going to need level 3 inputs to undertake that valuation. So you'll find most local government assets will have level 2 or level 3 inputs, and they're inputs that require some sort of adjustment or they're unobservable in the marketplace. So on the cost approach, this is probably one of the key approaches that local governments are familiar with. Just want to highlight some terminology that's used in the cost approach. So when undertaking the cost approach, what we're trying to do is we're trying to develop a hypothetical market situation with the asset where we're trying to replicate what the asset's remaining service potential would cost to construct. So AssetVal 13 refers to this current replacement cost. Sometimes I see that used interchangeably with the gross replacement cost, which is not actually correct. The current replacement cost is actually reflects what the cost is to replicate the remaining service potential on the asset, not the service potential when the asset was initially constructed. So to get to the current replacement cost, you generally start with the gross replacement cost, which is the cost to construct a comparable reference asset that's a modern equivalent, and then you deduct your obsolescences. So you got your 3 forms of obsolescence. You got your physical obsolescence, which is your physical deterioration. So that would be obviously the condition and age of the asset would come into that. Then you've got your functional obsolescence, which is to do with how if the asset is not as efficient as modern assets, then the subject asset will have functional obsolescence. So it's based on how the asset functions, and if I was to put an example, if you bought a 1999 Corolla, that would have functional obsolescence compared to a 2022 Corolla because it's less fuel efficient, it has higher maintenance costs and all those things. So there might be some functional obsolescence involved there. And then economic obsolescence isn't as common with local government assets because they're not used for profit purposes. But economic obsolescences could be anything from a change of policy by councillors that decides to abandon an asset, and therefore that asset becomes redundant. So there would be economic obsolescence involved in that. So it's any obsolescence which is created externally to the asset. So then if we go to the gross replacement cost, we we look at what the current cost is to replicate that asset in modern equivalent standards, and we have to adjust that for any excess utilities. So modern equivalent is always the lowest cost to replace an asset. So if your subject asset is, if there's a cheaper way to build that asset now, the modern equivalent is always that cheaper way to build that asset. If for some reason the modern equivalent is actually a more expensive way to build that asset, and there's, you know, I'm thinking of things like IT. So just say if you bought a computer 10 years ago, it might cost you a little bit more today to buy a computer, but it has a lot more power and a lot more storage and all of those things. What you have to do is you have to look at the modern equivalent reference asset and then adjust your subject asset down to what it is in comparison to the subject asset. So there's just some little terminology things there to sort of not get sort of caught out on the differences between gross replacement and current replacement costs there. Hand over to Nick now, who will talk about auditor queries and how best to handle them.
Yeah. So, you know, once we've gone through the valuation process, we've been out and done the inspection. We've prepared the valuation, sent it to council for review. We've knocked that backwards and forwards and refined and rinsed out any queries. The next step in the process is for the auditors to get involved. Ordinarily, that's been the process, but we're certainly starting to find now that we're getting involved with the auditors a lot sooner and taking them on the journey with us a little bit more, rather than waiting to the end of the valuation process. And we're certainly finding that is very helpful in smoothing out the whole process. So auditors have got their own standards to adhere to, but in terms of our interactions with auditors, the main thing that they are looking for from us is to provide robust methodologies that stand up to challenges, provide sound bases for assumptions such as useful lives and condition assessments and remaining useful lives, and provide sound reasoning for any material fluctuations from year to year, and to reference relevant cost guides and indices. So pretty straightforward, really. Essentially, the auditor needs to provide reasonable assurance that the valuation is correct. They're not looking for absolute assurance. So more and more of our time is certainly spent in providing supporting evidence. For example, if we've used 2 or 3 land sales as comparable evidence to support a valuation, we'll provide details of those and a narrative on how we've used those and adjusted them to support a particular land valuation. Much of our cost information comes from various sources that are readily available to the valuation industry, such as Rawlinson's, the Australian Construction Handbook, Cordell's, the Australian Bureau of Statistics, and if we can reference those in our reports and reference the particular page even that we've used to support the cost of an asset, just makes the process so much easier for the auditor. In terms of useful lives and conditional assessments, they're very much a subjective concept. However, they are concepts that more and more we're engaging with councils at the front end. The accounting standards don't prescribe to us what we should use for a useful life for a particular asset, or a condition assessment or a remaining useful life. As I said, it's very, very subjective, but If you, as a council or asset manager, engage with your valuers early around setting those useful lives and providing a reasonable reason for them, again, is something that the auditor can just tick off that we've had that discussion. And they do vary. Typically, with the useful life that we adopt has to reflect the asset in its environment. For example, if we put a useful life of 50 years on a metal roof in a coastal location, that very same roof might last a little bit longer in a dry location out west, because it's not exposed to salty air and rust. And that's a reasonable explanation to have a shorter life on a roof near the coast, as opposed to the roof in a dry environment. Auditors have a few means at their disposal for testing. They can test for the relevance and reliability of information, and they may select all assets for testing or specific assets or a sample. Given that most councils in Queensland have fairly large asset portfolios, we tend to find that auditors will pick either a specific asset or a sample. And the process there is that they would just ask us to put a little bit more meat on the bones of what we've already provided in terms of supporting evidence and the statement on our reasoning for the valuer inputs that we've adopted. Yeah, as I said, more and more we're starting to engage much earlier with auditors and sort of taking them on the valuation journey, and it's just makes that process run a lot smoother and saves all the queries from bunching up at the end of the process. And that sort of leads into how to make the valuation process smooth. As it says on the page there, it works best when it's well planned and sufficient time is allowed to undertake the project. I can't stress enough the importance of engaging your valuer early. We all tend to recognise that there is a bit of a financial reporting season that tends to run from sort of January to March, April, May. I know as valuers, that's when we're at our most busiest in this particular space. So I suspect that many asset managers and financial accountants that are on this webinar will see that, be familiar with being busy during this time period. Doesn't necessarily have to be like that. I know particularly in the state government space, we do quite a bit of work. We're out on site in July, August, September, and we have a valuation date of the 30th of March instead of 30th of June. Sorry, 31st of March instead of the 30th of June in the financial year. And then what we do at the end of June is just provide a certificate of materiality to cover off whether there has been any material movements between the end of March and the end of June, and it just buys a little bit more time, really, and it's certainly something that we recommend people consider. We have started to notice, haven't we, that tenders are coming out a little bit earlier now, which is great, and sort of removes that bunching up in that sort of March, April, May period.
It's also weather dependent too. Like a lot of local governments in Queensland have a pretty significant wet season during, that January, February, March period, and it can not be conducive to actually getting people on site to undertake valuations. So just thinking, having that clear plan ahead as to what months you want to undertake your valuations, I think will go a long way into getting a good outcome at the back end. So
yeah, okay. And as I've alluded to previously, the valuation report should contain plenty of evidence to support the values. If a valuation is provided that's well evidenced, then the auditors can see that due care and attention has gone into how those values have been arrived at. And again, as I've already alluded to, when the reporting entity, the valuer and auditor work together, it's just, as I said, something that we're starting to do more and more now is engage with the auditors and the reporting entity together throughout the whole process, rather than just leaving it to the end and then trying to fix anything. If we get in front of any potential queries and questions, the outcome tends to be a lot smoother. Okay. So as we mentioned at the start of the presentation, we've got Nathan Turner joining us from JLT. Nathan manages the mutual insurance scheme, which AssetVal provide valuations for. And given that there is a lot of synergy between insurance valuations and financial reporting valuations, we thought it'd be just a good opportunity to talk about those. Yeah. So I'll just hand over to Nick to talk about the difference between insurance valuation and a financial reporting valuation.
Yeah, just before we hand over to Nathan, we'd just like to speak a little bit about I guess the nitty-gritty of insurance valuations and how they sort of differ from financial reporting valuations. Financial reporting valuations are probably something that a lot of people in this webinar are pretty familiar with, have seen them quite a number of years, and that may not be the case with insurance valuations. And while insurance valuations, the key thing about insurance valuations that differ to financial reporting valuations is the difference between reinstatement cost and gross replacement cost. So insurance valuations will refer to reinstatement costs, whereas financial reporting valuations will refer to gross replacement costs. Reinstatement cost is the cost to reinstate the existing asset, whereas the gross replacement cost is the cost to build a reference asset that's equivalent to the subject asset. So the reason, the way I sort of think about reinstatement cost is that you're putting this reinstatement cost on it, for instance, say your council chambers. Just say you were to have a loss at that council chambers, there's every good chance that you're probably not going to lose the whole building, or you'd hope not anyway, unless it was a pretty significant event. So that reinstatement cost has got to cover you for rebuilding potentially a part of the asset. So it should be thought of as more of like building a replica rather than building a modern equivalent asset. So that from a definitional point of view, that's probably the main differences from there. But then when you're looking at insurance valuations, you're looking at an insurance value based on a policy period. And often that policy period is, say, for 12 months. So within that insurance valuation, there's an allowance made that the costs may increase during that 12-month policy period, because you may have a loss, say, at month 11 of the policy period, and you might have had your value set at the renewal, which was the start of the policy period. So there's some additional costs and factors that are allowed for within an insurance valuation that may not be allowed for in a financial reporting valuation. It's not really something where you can just go, well, look, yeah, we've got these replacement costs for financial reporting, let's just translate them into insurance values. There are some key differences there that have to be considered and accounted for. So on that note, I'll hand over to Nathan, who will sort of in more detail explain from the insurer's point of view what they're sort of looking for and what he's sort of his experiences are with that.
No worries. Thanks, Nick, and thanks to the LGFP for having us along today. As Nick touched on, valuations are certainly an important component of the insurance process. And look, there's some fundamental elements to that. So ensuring that you've got the right value is critical from the perspective of, setting limits of liability, deciding what type and level of cover you need to purchase, and also fundamentally from the perspective of how it drives cost. So the value that you've declared for cover is one factor or input that goes into determining cost. And I think that's probably an area I'd like to focus a little more on today, rather than the nuts and bolts of insurance valuation. I'll defer to the team at AssetVal to talk to that. But really, I might start from the premise of information being a driver or enabler of competition in this space. And as I touched on earlier, risk information, so that's, what is the asset? Where is it located? What's it made of? How old is it? What sort of fire and security protection exist at the location? And the value itself are key inputs when insurers or the mutual, for those of you that are members of LGM Assets, look at exposure and look at pricing risk. So it's a little bit like any kind of investment decision that you make, where you've got poor quality information or gaps in information. You've got a greater degree of uncertainty or a greater potential degree of risk there. So there's an increased need for assumptions, greater possibility of risk, a greater degree of uncertainty. What that essentially means is, as I said, like any investment that you make, it's risk reward. So the greater level of risk or the greater level of uncertainty, the greater the level of compensation you need to take that risk. So in other words, in this space, gaps in information get filled with price. That's an adage that, or a way that I like to think about it. From the competitive side of things, without this information, so not only is it a case that gaps in information are going to result in increased assumptions and an increase in cost, it may also be the case that insurance or reinsurance markets, so for those unfamiliar, reinsurance is essentially where insurers transfer their risk to other financial or insurance without sufficient risk information or some degree of understanding as to the credibility of the numbers that are being put in front of them. So they really need to understand with the numbers that sit in front of them so that they can then say, okay, we can price this risk with some degree of certainty. So without the benefit of accurate valuation and accurate risk information, you start to become captive to a limited number of markets. You reduce your ability to engage the full breadth of the market. So what we also see in terms of the importance of valuation to competition is by having a consistent and standardized data set, you're actually able to talk with them on the same basis. So you're able to engage with them using the same terminology and the same information that they themselves use. So you're in effect reducing their bargaining power by improving the level of information. So you're no longer dealing with a situation where you've got information asymmetry. So in the case of LGM Assets, the mutual has a valuation program. It also has a catastrophe modelling and actuarial studies done on that information. And the purpose of that is so that when we go to supporting insurance and reinsurance markets on behalf of the mutual and its members, we can do that with the benefit of a comprehensive understanding of the risk. So we're not flying blind in a sense when we talk to insurance markets. So by improving the level and quality of risk information through the valuation process, we can reduce the degree of uncertainty, the need for negative assumptions, start to attract insurance and reinsurance capacity that might not otherwise be available without that information, and thereby, as a result, generate some competitive tension, and naturally develop an understanding of the true cost of cover and make informed assessments about program structure, market participation, and ultimately risk mitigation and management. As we start to delve into the risk and the exposure piece with the benefit of accurate and comprehensive information, we can really start to see things like where pockets of exposure or aggregation might exist, and start to think about what do we need to be doing to reduce the risks that might otherwise exist in those areas and spaces for the benefit of the mutual and its members, or in the case of individuals, for the benefit of themselves. I might just ask Nick if you can go back one slide.
Sorry, yep.
Yep. It might be a little bit difficult to see. Hopefully these slides will be shared following the presentation, but really this is just a way to, I guess, break down some of the concepts that I just touched on and start to see just how important valuation and information as part of that process is to ultimate cost. So if we look at how your insurance cost is calculated, it's a function of the declared value, so the value that's actually at risk, and the unit rate. So that's the cost per unit of insurance, which is normally in the $1,000 unit. So your declared values are made up essentially of your building value, your contents values, and any business interruption values. And then your rate is a function of exposure, expenses, claims experience, so how have the things performed, and the reason we look at that is, past history is often a reasonable indicator of what future performance might look like. And then we look at assessed exposure. So, what are the frequency of events? How are those sorts of things playing out over time? So where we want to get to with the valuation piece is to start to fill in some of these gaps, and it's useful to, we sort of see it as useful to break it down on this basis so that we can start to see where we can have influence on things. So where we've got gaps in information that we might be able to fill, we can then start to have conversations with the mutual and members about, if we've got particular aged risks in the program, what does that look like from a risk mitigation, risk management perspective, asset management perspective? And what sort of conversations can we have with members about where we've got aging assets, for example? Is risk transfer really the appropriate mechanism to be using to manage those risks? So are these things that, if they were destroyed, do we really want to rebuild them? So by going through this process, we start to develop a bit of a picture of not only the value at risk, but also the ultimate exposure that sits in behind that. And it can start to inform some conversations about the substance. If you can just move forward to the next slide. So just a little bit of information on the LGM Assets Valuation Program. I won't sort of labour this too much. Nick, the two Nicks have already sort of touched on some of the nuts and bolts aspects of this, but the valuation program is really an exercise to determine current insurable values of buildings and other structures. And as part of that, collect accurate risk information. So we're trying to develop a comprehensive understanding of the exposure, get some transparency with respect to the input costs of covers, and start to make meaningful and targeted investments in risk mitigation. Next slide. And in terms of why have a valuation program, really it's an aid to support the mutual to achieve its objectives, or any insured in achieving their objectives. So in the case of the mutual, that's about stability and sustainable coverage costs for the long term, having a valuation program will best position the mutual to preserve coverage, contain pricing, and ultimately leverage scale to drive competitive tension. What we're seeing in the market at the moment is a real focus on valuation. So insurers asking a lot of questions about where these numbers are derived from, what is the process that's being gone through, how are insureds dealing with cost inflation. So being able to answer those questions is critical to making sure that we can continue to preserve the cover that's in place without things like average or under insurance clauses being inserted. We can continue to contain pricing because we've got some certainty around and some understanding of what the exposure looks like. And we can use this information to start to leverage scale to drive competitive tension, engage the full breadth of the market on behalf of members, and do that in a way where we are a market maker rather than just a price taker. So using that information to remove any assumptions. So that's probably all I really wanted to touch on in terms of the insurance piece today. And I might throw it back to Nick to moderate the question and answer.
Great stuff. Thank you, Nathan. Appreciate your time there. That's a useful bit of information. As I said, there's a lot of synergy between what we do in the financial reporting space and the insurance valuation space, given that a lot of the valuations we do are cost-based. Yeah, there's a lot to be said for both those projects. We've opened up the live Q&A session, and we've got a question here from Tony, who says that useful lives and unit rates are key inputs to reviewing the valuation process. How often do you think councils should update their assumptions and guidelines for these, particularly in the current times where spikes in material costs, which may be short term, are inflating unit rates and replacement costs? Yeah, it's a good question and very, very topical at the moment. If we split that into two, useful lives, I would say don't particularly need to be reviewed that often. They tend to be fairly stable once they are set. Sorry, that's total useful lives tend to be relatively stable. Remaining useful lives can be affected by severe weather events, so they are reviewed on a much more regular basis, for sure. But it does tend to be a reactionary process rather than a proactive process. As I said, we can't predict when severe weather events would come in and significantly affect an asset to reduce its remaining useful life. We tend to get involved with that, reviewing those after the fact. Unit rates are a very hot topic at the moment. Nick, do you want to just talk about that a little bit?
Yeah, so I think I sort of mentioned earlier in the presentation about valuation cycles and indexation. So, I mean, unit rates really, they go through a thorough review process every comprehensive valuation. So it depends on council's, policy, whether they do it every 3, 4, or 5 years. I think a lot of now with how pressures are on costs, I think those cycles may start to shorten a little bit due to materiality and things like that. But so obviously they'll go through a thorough review in the comprehensive cycle, but it's really important in the interim years to be applying some sort of indexation rate that reflects what's actually happening in the market. So whether that's, engaging a valuer to undertake an indexation exercise, or I know a lot of councils are doing it in-house where they're looking at the relevant indices, as long as some sort of adjustments being made in the interim years, that would be sufficient. But yeah, it's hard to sort of predict what's going to happen in the next couple of years and sort of how quickly costs are going to go. But I think at least every 12 months there needs to be some sort of process that council goes through where they look at what the changing costs are since the previous comprehensive revaluation and comes up with some sort of justification and identifies whether there's been a material change or not. and that can be undertaken using external valuers or internally, depending on how they do it. So.
Yeah, we're certainly seeing some big splashy headlines at the moment around escalating construction costs. But you know, if you sort of dig down through those numbers, they do tend to be a little bit sector specific.
Correct.
I know, speaking from my own experience, I'm trying to build a house at the moment, and the cost has gone up about 40% since we first engaged a builder to provide a price for us. That said, whilst that big escalation is across the residential space, most residential assets tend to be valued using market approach anyway. So the costs escalations that we're currently seeing aren't having a huge impact on the valuation of residential assets. You know, we are seeing more significant movements in things like concrete prices and steel prices, but the indices that are starting to come out, the Q1 indices that we're starting to observe now, are showing much more modest overall increases in construction cost.
Yeah, it's really asset dependent. You know, obviously assets that use a lot of precast or a lot of, you know, structural steel or things like that are obviously going to have a bigger increase. But I'm just thinking out aloud, like a large portion of council's asset portfolio is generally made up of roads, and if you think about it, a lot of councils use their own material for roads, they use their own staff for road making and things like that. So they're probably not going to see the same cost pressures that other asset categories are going to have. Obviously, if they're using contractors and whatnot to build things like bridges or culverts or things like that, there may be some of those cost pressures, but on the whole, some of those, you know, tailwinds are sort of going to be mitigated by using their own labour and materials. So.
Cool. Next question is from Anthony A, which is a little bit of a curly one. So how do you think valuers or council should deal with auditors when they disagree with methods or outcomes, or if either of the three parties disagree?
They shouldn't disagree with methods.
No. As I've alluded to earlier in the presentation, we've started to engage with auditors a lot earlier in the process and start to set the scene a little bit more, rather than wait till evaluation's done and then start sorting out any problems or queries. Then, you know, we rarely disagree on methods, but I'm sure it does happen. You know, the valuer should be professional enough to select the appropriate method of valuation, but we see this valuation process as collaborative, rather than a valuer just telling you how it is and that's the end of the story. You know, we don't dig our heels in when we don't particularly have to. And if a valuer has chosen one particular method to value an asset, and then further information comes to light throughout the process that would enable that valuer or to change his methodology, then we do that. It's all about having the right amount of information and the complete set of information up front. Allows us to go through the valuation process a lot easier and a lot cleaner. I think the other thing to say is to respect each other's roles in the process. I have on occasion had an auditor tell me how to try and value a particular property, and so with the greatest of respect, it's my job to tell you that, not the other way around. And he wasn't in Queensland, by the way. It was a different state. But yeah, as I said, we adopt a collaborative approach, and with the end goal of providing a valuation outcome that is robust, acceptable, and defensible. So the earlier we engage with the auditors on things like queries, the quicker we can resolve anything that they query.
I think a key thing too is we try and make it evidence-based as well.
Yeah.
Like we collect a lot of evidence with our valuation projects. So if we ever are questioned on it, we can sort of show it to them and go, well, look, no, this is, if they say, this doesn't seem right, or we can go, well, here's the evidence, here's these project costs, or here's this, page out of Rawlinson's, or so on and so forth, to explain, the process that we've gone through. So at the end of the day, the auditor's there to basically, check the evidence and check that everything stacks up, that they're not really there to sort of, guide the process or how you should have been doing it. So yeah, we did generally try and take an evidence-based approach to that. So.
I think that's all the questions that we've got for now. Just double check.
Well, thanks, Nick and Nick. That was, very valuable information in terms of, how to go about evaluation, just some of the basic concepts, how councils need to comply with accounting standards, to meet audit requirements and make sure values that are in the financial statements and are used for a variety of purposes. It's not purely just an accounting exercise. It's a lot more holistic than that, isn't it? So,
Exactly.
Nick, just probably just your views on, and Anthony, he's really good at asking tricky questions. But just further to that question, you think obviously engaging with the infrastructure areas of council, the asset management teams, so finance, whilst they don't purely own the valuation process. I think it's more of an organisational ownership where your engineers and your asset management professionals are also heavily involved, and you probably deal with them as well. So, and so do you obviously agree that councils, once you provide the information, they really need to sit down as a group, the three parties, and actually work through the data and make sure that they're happy with that, and then reach a consensus which will potentially eliminate that conflict or potential issue with the audit office in terms of challenging assumptions? Is that sort of where your thinking is as well?
Yeah, you've 100% hit the nail on the head, Michael. It always works best if we have that sort of open discussion between finance, engineering, asset management and us, because we can provide the valuation, but no one knows the assets like the asset managers or the engineering. So they'll often find things that go, look, oh, this asset isn't what it says it is here. There's these particular intricacies with it. Here's a bit more. As long as there's what we tend to do is, as long as we provide with that information that we can sort of justify what we're doing, we're sort of happy to run with it. So, if we sort of, discuss with asset management and they go, oh no, unit rate should be, 120, not 100, based on these reasons, here's some recent project costs that back that up. If we get that information, we go, yeah, great, that's fantastic. We'll keep that on file and use that when we're discussing with auditors justifications and things like that. So short answer is basically yes, the more interaction and open discussions that can be had between all parties, the better the outcome will be.
Yeah, for sure. And look, we've got, hopefully the session doesn't cut off. We've got 15 seconds left, but if it does, just for the viewers out there, it's the system says no, that's it. However, I might just continue the conversation a little bit just around the process and to make that a smooth process. So obviously for councils, it's early preparation. So think about well in advance your cycle of your revaluations, engage a valuer early. I think I really was interested in that point you made about a certificate of materiality, where you can actually get a valuation done early and then review it. So you can do all the work up front. You're not waiting until May, June. It's not the year-end rush, which causes probably issues for valuers as well as councils. If there's a logjam of valuations to do, it becomes problematic, I'm assuming, for you guys, as well as councils getting the outputs and then feeding that through the process. So that's, I think, really important. Planning early, engaging with your valuers early, if possible. It gives you guys then the opportunity to plan ahead, and meet demand, which is, you know, everyone's doing the same thing, aren't they? And also, sorry, Nick.
Sorry, look, I mean, there are a limited number of valuers that are experts in this space across Australia, and you know, I'm sure I speak for some of the other firms as well, that our books get filled up very, very quickly, to the point where by this time we're actually starting to turn a little bit of work away. So you know, that just stresses the point that early engagement is key to getting the process done smoothly.
Yeah, and I think probably for the finance people out there listening, it's again, once you have that information from the valuer, then, you know, reporting the outcome through your audit committees, where you have audit committees, engaging with the auditors early, so that once you do reach that critical period of closing off your books, doing your statements, you're actually not under significant pressure, and you've worked through issues. Your audit committee is happy with the outcomes, and then you can finalise your accounts without risk of delays in completing your statements and looking for extensions, so on. Because as we know, extensions are generally aligned with asset valuations, because that's the biggest significant piece of work as part of that financial statement process. I think it's really important, as you said, about, you know, councils working with yourselves and the QAO and the audit contract auditors to, you know, it's an ongoing dialogue rather than a conversation at year end. So and I'm sure you see that, the benefits of that, rather than you know, the latter.
Yeah, well, we've all got the same goal, so it's easier to work towards that goal together rather than disjointed and come together at the end.
Yeah, and finally, probably on this topic, just the importance, as Nathan mentioned, obviously councils need to realise that insurance prices in risk. So if your asset data isn't up to speed, and LGMS aren't, you know, have a little bit of concern on the accuracy of that data, they, you know, obviously you'll pay for that to a relative degree. So there is an incentive for councils to get your asset data correct. And that will then help in terms of your ongoing cost of insurance, which I think is, you know, everyone's under pressure at the moment in terms of their financial sustainability. So, and the better data LGMS has, obviously, the you know, the better they can assist councils with managing that risk around insurance. And yeah, so look, that's we probably run over time by 4 minutes, but at least the system allowed us to stay on. So look, appreciate Nathan and Nick, your time, and Nick's. I think really valuable session. And look, for everyone out there, our webinar next month will be around internal audit. So internal audit, we'll have Crowe Australasia presenting that on May the 26th. So look forward to anyone with an interest in internal audit, please register for that webinar. But until then, thank you for your time. And again, thanks to Nick and Nathan.
Thanks, Michael. Appreciate that.
Thanks for having us.
No worries. Thanks, Michael. And thanks to the LGFP for having us.
Appreciate it. Thank you.